What's up, everybody? Michael Silva here. A brutal week in trade indeed, but things can be setting up for a Santa Claus rally. So I want to give both the bullish and bearish case here in today's stock market brief show. We already know CPI came out a little bit less than expected. The Fed, they rose rates by 50 basis points, bringing it to its highest point since that 2007, right before the recession kicked off. We had retail sales, manufacturing declines. We had the ECB and BOE, they raised rates. We have that stocks that have fallen those last 3 or 4 days in a pretty significant decline. And, Wall Street Journal's reporting that it's because of recession, concerns. We have Goldman Sachs also plan on laying off thousands of employees. And now we're starting to notice that slowing growth is edging out the concerns of inflation. As you can see, when the inflation report came out, under expected, it did start high as far as the market ripped up higher, but then it started to fade very shortly thereafter. So Americans are expecting worsening U.S. economy in 2023. There was one of the questions on the poll was, do you think the U.S. economy will get better, get worse, or stay about the same? And the majority of people did say that it will be getting worse. Another question that they ask here is, thinking about you and your family, which of the following best describes your situation when it comes to the cost of living? And you can see here, the orange line is what had the highest pull there. It's rising and creating financial strains. What did the S&P 500 do? Well, the S&P 500 started off, above the weekly expected move off that CPI report, but then sold off for 3 straight days, tagging its lower weekly expected move, closing within the weekly expected move. So nothing too crazy. It was a lot of volatility, but it still managed to close within there. And you can see it's just following the current trend of a series of lower highs and lower lows. So the question remains, are we going to break down further? Are we going to retest this lower level? And this is all a possibility. I will state in this video, you will see that things are getting very extended to the downside because of this sharp 3-day sell-off. If we take a look at going into next week, we're looking at about a weekly expected move of around 39.50 to the upside, 37.50 to the downside. So that leaves a lot of room to come test this middle portion of the channel and or come and back test the prior breakdown area, which we've saw some increased volume. Yes, we had quad witching, right? Yes, we had increased volume on the day prior too. So these are considered distribution days. And when you have more distribution days piling up on each other, it's not a great sign for the overall market. If we zoom in though and take a look at the 15-minute time frame, what should you be paying attention to going into next week, maybe early trade on Monday? Well, these are the expected moves on the SPY. So 374 to the downside, 392 to the upside. Understand that we broke this area, so this is now considered overhead supply. What is that? Well, that means that if prices come back up into this area, which is just about that upper weekly expected move, this could be a good area to potentially start shorting into, or if you're going long, to take some profits, because there's a lot of trapped supply up here. And then if prices come back up here where they're back to break even, they may sell into that price action. And you can see that we do have that volume shelf profile here. If you look at that as a distribution curve, can act as a magnet coming back here, which is still beneath that 5-day moving average. Beneath this, if we get some more sell side activity, start looking at this gap to get filled. Also the lower weekly expected move, so around 372 to 374. Those are some levels that I'm watching going into next week, above us and below us. Remember, it's holiday trade. We can still see some more sell side activity. That's always a possibility, but just remember that typically holiday trade slows down a little bit, and we typically get some sort of Santa Claus rally right as we get this end of year markup. We'll see, right? And you got to understand the S&P 500 is actually now just moving back into bear market territory, right? We got out of it this prior month. This is a monthly candles. We got out of it this month. We got out of it this month, and then we're back into it, obviously, just on the last trading day's session. But I will call out that we are right here at the lower monthly expected move and right at bear market territory. So the lower monthly expected move is this solid line right here. The upper is right here. This right here is the quarterly, which is also ending this month too as well. If we take a look at the 65-minute time frame, the reason I want to show this is because I want to just show more price action. When we were down here, this was the chop box. We created another chop box up here. Then we're kind of just in no man's land right here in between, obviously, the weekly expected move. So if we start breaking down into this area, this opens the door to come right back into this really volatile chop box here. We remember over here where CPI came in, I think there was a hotter expected, and then it ripped up, and everyone's like, hey, it's, game on, right? We're going straight up, and now we're starting to see a little bit more weakness, even despite the cooling inflation over here. So yes, this is a chop box. This is a chop box. Are we going to end back up into this chop box, or are we going to end back into this chop box? Keep an eye, like I said, on these levels on both the upper and the weekly expected move on the upper and the lower. Sorry. Now, if we take a look at the Qs is also down there at that lower weekly expected move, very well into bear market territory. The red line right here is basically taking 20% from here, minusing it, right, minus 20%. We end up right down here, and you can see price action is clearly getting smothered just there in the Qs. Not nearly as bad as in the S&P 500 because, well, there's a lot more different sectors versus just tech. IWM also well into bear market territory, and this is also getting beneath that monthly expected move. So these are important things that I want to call out, okay? We've had distribution days pile up, we had a sharp sell-off, and we're getting back beneath these monthly expected moves, and there's still obviously quite a bit of time left in the month, so we have a lot more trade. So will price, 68% of the time it closes within these expected moves. So will price come back up a little bit and start closing within there? It's anybody's bet at this particular point in time, but some of the other indicators that I will show you lead me to believe that we can see a potential bounce, right? Now, you understand, breakdowns occur. So crashes occur from these overextended levels too as well. So we can't just, throw caution to the wind. You got to be tactical still. Take a look at the dollar. The dollar is going to be an important asset to watch because when the dollar goes up, typically the S&P 500 has been going down. That's what we've been seeing as far as the trend goes this year. But we're pulling into a prior area of trend. You can see we had a series of higher lows and we're pulling back into it. We're kind of far off of it at the moment, but if we pull back, that could always potentially bounce. We are also wedging. We have a subtle positive divergence right here, subtle positive divergence right here. So if the dollar starts breaking out, that could put more pressure on the downside of the S&P 500. However, if we get an end-of-year rally, maybe this comes down a little bit more, something like that, and then it still holds within that wedge structure, we'll continue to monitor and see how that develops. We also have that back test going on the larger weekly time frames where we had these big falling wedge structures. And then when we broke out of it, now we're back testing into this area. You can see this candle right here is a hammer candle. So if we start crossing back above the high, maybe this marks a bounce point. Typically these type of hammer candles, they look like this, right? It shows basically it was once a big red candle all the way to the downside, but the bulls stepped back in and they pushed price back up, giving that big lower wick. Okay, so that's what we got going on so far. The dollar is a very important asset to watch. I want to go into some signal charts, and then I want to go into the zones and share with you some of the charts that I share with my Discord. So here's the BPSPX. As we noted, right, it was getting overextended to the upside. We gave many, many warnings, and we said it cycles from overextended to the downside, or overbought and oversold conditions. Okay, it rotates between those. And now you can see that negative divergence, it played out to the downside. So it's heading down. It's still at a decent level around 50, so it could head lower. Looks like it is. And then the RSI is moving back into that oversold condition, which could set us up for an end-of-year potential rally, right? When things get extended, I like to look, for potential positive divergences or just overextended areas, and it lets me know to take the foot off the gas a little bit. You can see the last time we were here, it got overextended, stayed there for a while, but that did mark some sort of a bottom, temporary bottom there. And then one before that, bam, right here, bam, we started moving up too. Okay, so the BPSPX, this is a big one, is moving into the oversold condition. BPINFO, so we're going to look at the three big horsemen, the three big sectors in the S&P 500, technology being one of them. Bam, we're moving into that oversold condition. It's at 30.98, it's pointing straight down. Looks like it's going to be getting there very soon, probably within the next trading day or so. BPDISC, this is discretionary. So think of XLY, right? Consumer discretionary. It's not quite there yet, but it's moving back into the oversold condition from what? From being overextended to the upside. Then we have financials are in oversold condition. It's at 25.40. Financials have been getting cracked. We talked about this negative divergence that could potentially play out. We talked about it, right? And bam, we're going to the downside. This is why I like looking at these charts, because it preps us for potential pivot points in the market. Well, yes, you might be super bearish. You may have caught some of this move. Now, what do? You pay attention to where these signal charts are. And as it stands right now, it doesn't mean that it can't sell off more. But you got to understand, if you're not taking a little bit off the table or positioning yourself, properly, just understand that you'll have to deal with more volatility, and you can get, your face ripped off potentially, right? Not to say that that's going to happen, but we can see down here, came back up. Down here, is it going to come back up? Yeah, it will at some point. Now, if we take a look at the broader market, the New York Stock Exchange Bullish Percent Index, this was a negative divergence. We've been calling that out. Bam, now guess what? We're moving back into the oversold condition. Should be there in a few days. If we take a look at the BPCOMPQ, this one still has room, so this is also a really large one, 38.55. This one is not near it, but yet it is pointing down, and we have the BP chart pointing down. So this looks to me like we'll probably get there at some point. You got to understand, this is also a positive divergence we called out, right? And that marked that bottom, and we saw a little bit of a rally. The tech stocks didn't really get anywhere too much. It wasn't that great of a rally, but we are moving back down into the oversold condition. Okay. So this is all important, right? We're one. Okay, we'll recap this. We're one. We broke down from a key level. We had a strong sell-off, okay? The strong sell-off brought us to these lower weekly expected moves. The lower weekly expected moves, right? I'm sorry, monthly expected moves, and also the weekly expected moves we were tagging. The Qs actually closed outside of it. The S&P 500, I'm going to give it to it. It tagged it. It looked like it did, but missed it by $1 or $2. But it's a $4,000 product. And then we have these BP charts that are back in also to moving oversold conditions too as well. So yeah, it might have a lot of fear over in the overall markets, but we have a lot of charts that are saying, hey, if you're not taking some profits on your short positions, you may want to consider it at least. Can it fall further? Absolutely. Can we get more sell side? Could it be like 2018, right? Yeah, of course. But just if you're being tactical, you got to pay attention to this kind of stuff. All right, now let's go ahead and take a look at the zones. The zones, you're going to notice a lot of green on the screen. What does this mean? Well, think of this indicator as kind of just like Bollinger Bands in a way, but it allows you to see I like to use them for risk management, and it allows me to see like a wide, broad market, and it gives me an idea of when things might be getting overextended to the upside or downside. And you can see here we have the low portion of the zone, the high portion of the zone, the mid, and then you have the closing price here for all of these assets. And then it'll give you, okay, so where is price within there? It'll give us, a percentage to the upside, percentage to the downside, to the lower end or the higher end. And then the range is really just giving us color coordinate of where it is. So when it's bright green or when it's at 0, it's basically meaning, hey, the Qs, right? The low is at 271.76, and we closed, 274. So it's at the lower end there, or it tagged it the prior day. Okay, so that is what that's telling us. A lot of these all the greens basically mean that these assets, so we have the SPY, the Qs, IWM, the diamonds, XLY, they're all at the lower range. And we know this because we had a strong sell-off. Things are getting overextended to the downside on the BP charts. Now the zones are also telling us, hey, things are getting overextended to the downside, which could lead to very well a potential bounce. Okay, so yeah, that is what I'm seeing right there. The big thing, the big thorn right now is that dollar. The dollar is not overextended to the downside, and it's also wedging. So if the dollar wants to start breaking out, all right, that could very well mean that we see more risk off type behavior. The last time I pointed out the zones, I believe with HYG, that was actually turning red here in the range. We said, hey, be careful here because this overextended to the upside. There's a strong correlation that if this goes down, you might see obviously the markets go down, and the markets did go down. Everything's in the green. I want to show you right here. This is the top 10 of the S&P 100, or top 9. It's just 2 Googles. You can see here, Apple, Microsoft, or not really Microsoft, but close to it. It's towards the bottom end of the range. We have Berkshire Hathaway, we have Google, Amazon is pretty close to the lower end, Tesla, right? These are all bright green here too, and these are large market cap names. So large market cap names, they sold off greatly. This could bring some sort of bounce back into the market. It could bring some sort of euphoria, or just setting overall for that Santa Claus rally. I wanted to point this out too, so you can screenshot this. These are the expected moves that I share. These are some of the products that I share with the Patreon group, which is the link is in the comment if you want to do that. It's part of Patreon, but I do everything on Discord, so you have to sign up through Patreon, sync your Discord. I have a little getting started video there too or post that shows you how to do that. But this is the upper expected move right here for the week. These are the lower weekly expected moves. This is the range. Okay, so the plus or minus, this is basically, hey, I can go up or down this amount of dollars. Look at Tesla. Tesla is saying, hey, I can go up or down $11 next week. That's a huge, 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 huge range right there. You have Netflix is 14.76, right? That's a bigger product, but still, these are some large areas of volatility going into next week's trading session. I wanted to call out here to Apple. Apple is pulling into, well, what do you know, a prior area of demand, right? So we had support right here, boom, support right there. And now we're pulling back here after 4 days, right? Or almost 4 days of pretty strong selling where we gapped up, sold off, then sold off, then sold off, then sold off again. And last time we came into this area, we have seen the market bounce from these levels, as you can see. So I would like to see a little bit more weakness, right? Maybe flush out a couple more people and then potentially try to take a stab just with a light risk and see if we can catch some sort of Santa Claus rally. And if I get stopped out, okay, whatever, it's a couple dollars per share, but it's a good way to potentially take on a little bit of risk in a big product. And this has a huge weight obviously in the S&P 500. So if we start bouncing up, you can catch potentially $5-10 per share, who knows, if we do get some sort of Santa Claus rally. Tesla also, if you look at this as the head and shoulders, this is crazy to think that, this is why the market can still go down, after it works off some overextended levels. But if you look here, this is the pre-pandemic high, and that's bringing us to around $60. And most stocks, right? Most stocks have reached down to that level. Some even on top of that have reached already below its pre-pandemic low or its COVID crash low. And that would bring us to around $20 to $60 in the price of Tesla. It's as if it just matches up with some of these other stocks and names that we've seen. And I'll tell you what, if this is a head and shoulders, which I'm not predicting this to happen, but a full measured move of that would bring us down to around $23, which would be the COVID low. And that would take the air completely out of this bubble. This has been the monster bubble stock here. But you can see 16% down on the week. That is a very, very strong sell side. And if you just draw a line like this, where you had a low here, it bounced, a low here, it bounced, and then we had a 16% drop this week. Maybe perhaps that if we do start to see a bounce, we can catch a couple of dollars per share there too as well. So that is another opportunity. As we know here, as we noted here, Tesla is at its lower range right there, or lower end of the zone. The last thing I want to show is also global ETFs. Global ETFs, if you just look across the board, look at everything's towards the lower end of the range. So as we saw a couple day high move in the dollar, right? So the dollar right here, we saw, 1 day up, 2 day up. This bounce here has put a lot of heat on the S&P 500, various other assets. And you can see here that it's also taking down global ETFs here too as well. So as we're getting ready for next week, as we're hitting these monthly lower expected moves, I would like to see some more sell side activity, and then I would like to take some sort of stab. But that's kind of what I'm looking at going into this next week's trading session. Everybody, hope it helped out, gave you some insight into what is I'm seeing. Please be careful out there. If you're really bearish, it's not always the greatest thing to short into the hole, and this would be, in theory, shorting into the hole. See you later.